and welcome to the BioSyent Inc. Q1 2017 results presentation. My name is Rene Gorham, and I'm the Chairman, President, and CEO of BioSyent. I want to start today's presentation with a look at our sales, EBITDA, and net income after tax for the first quarter. So obviously ended March 31st. So our sales reached a bit above $3.8 million, and that was 1% ahead of the year ago period in 2016. Our EBITDA was just under 1.2 million, which was 6% below a year ago, and our net income after tax was a shade over 900,000, which was down 5% versus a year ago. A couple of quick comments on the items that would have impacted those results. One is just on the mix of the business, sales mix. So as our company evolves and we have a number of products that are contributing to the top line, not all of them have the same basis of gross margin, and not all of them are at the same age and stage in their evolution and development. So some of them we're investing more as a proportion of sales, and some products less. Some markets we have a greater gross margin contribution. This whole mix is taken into account both in our top line, our gross profit, obviously, and our investments to deliver our EBITDA and our net income after tax. So there was some impact of the sales mix on our earnings and net income. Certainly we did have an effect on the top line of some wholesaler inventory, I'm going to say, adjustments coming out of 2016. In the next slide or two, I'm going to speak to that a little bit more specifically. But we had some excess inventory at the end of the year in 2016 that our customers had to work through. We just found generally our wholesale customers as a group carried significantly less inventory at the end of the quarter, so March 31st, than they traditionally had, and certainly versus the year ago quarter. And we think that had somewhat of an impact on the top line. So looking at sales for the quarter for pharmaceutical products reached 3.65 million, a modest increase of 3% over Q1 of 2016. Why was that not 1%? That's because our legacy business also contributes to the total company revenue. The legacy business was down versus year ago. That business is inconsistent in its performance. One of the reasons why, obviously, we are more focused on the pharmaceutical market. We had an exceptional year in legacy products last year, and we'll be working against those comps a little bit as we move through the balance of the year. FeraMAX 150 unit volume decreased 8% in the first quarter of 2017 versus 16. This was generally affected by these two impacts of inventory. So year end, one significant customer essentially was carrying too much inventory and had to consume that in distributions to pharmacies as the year began. And then as a group, our wholesale customers looked like they had about 1 week less inventory on March 31st, 17 versus 16. And those two factors together had an impact on our top line. And obviously that incremental revenue would have contributed to a stronger EBITDA and net income after tax. Of note on FeraMAX is that our customers' sales to pharmacies, so wholesalers' sales to pharmacies, which we describe as secondary sales, increased 11% in the first quarter versus the prior year quarter. So double-digit increase in demand from pharmacies. This is the closest that we can get to reading actual consumption by patients, because pharmacies don't bring product in to the pharmacy and to the behind the counter unless they have demand from patients and consumers. I could also let you know, although it wasn't necessarily in the first quarter, that our IMS data, which was reported at the subsequent to the end of the year, showed that we had a strong fourth quarter. We reached an all-time high of market share for a 12-month period, I guess measured for a calendar 12 months. And actually in the fourth quarter itself, we hit an all-time high share as well. So all of the indicators on consumption are pointing up for the FeraMAX business. We had this blip in customer inventories. Kind of going down the product list, looking at some of the other products. FeraMAX powder Canadian units were up 4% versus a year ago. This, is really a complementary product to FeraMAX 150. It already enjoys a high teens share of the market that it competes in, so we expect modest growth from this product as we move forward. Repagyne units were up 37% versus year ago. Cathogel jelly units were up 16%, Q1 17 over 16. This is now our fourth consecutive year of solid double-digit growth. That product was launched in 2012. Don't be dazzled by the Agaton system increase. I won't even say the number. You can see it here on the screen. The thing that you need to realize is that the Agaton system was relaunched at the end of the first quarter last year with the atropine PFS, and then we launched phenylephrine prefilled syringe in November. So really looking at year over year figures, not that informative. I think it'll be about a year until we get into Q1 next year where we're really looking at an apples to apples of how the business is doing. Our international business for FeraMAX, which we measure in dollars, not units, because of various price points and product put-ups, we're up 17% in the first quarter. We do have orders already on hand. Some of them have started shipping. We expect continued shipping in this quarter, Q3 and 4, and have visibility to that business growing greater than 50% in 2017 versus 2016. We're obviously pleased with 17% quarter-over-quarter growth. When we look at the full year performance next January, we'll see a much more substantial growth curve for this product. We'll take a look at our pharmaceutical sales by quarter for the last 20 quarters. You can see we had a steady progression over time with a little bit of an anomaly Q1, Q4. So it's not unusual to see a drop in the first quarter. If you look at the year ago period, 2016 Q1 versus Q4 2015, you see a drop. There's a couple things that accentuate that. One is the trade inventory management issues that I spoke to. So you see a little bit more of an accentuated spike upwards in the Q4 2016 period. You see a little bit of a dampening in demand in Canada for FeraMAX. Those two factors have an impact in what you see kind of visually as quite a spread. FeraMAX international business, which I've spoken of a fair bit in the past being quite lumpy, continues to be so. You can see, I'm not going to break down the individual dollars for you, but you can just see the illustration of the international businesses, the portion in each bar, each quarter bar that is blue. You can see that the international dollars were down in Q1 versus Q4 by 40%, and in fact lower than both Q4 and Q3. We've spoken about this in the past, that this business is typically more lumpy, larger orders, many more weeks and months supply purchased in one order. If an order does or does not ship in a given quarter, it has an impact over time. Obviously this would be significant with a drop of 40%. That business now contributes a greater percentage of our total revenue. We're still feeling quite comfortable about how that business is tracking, as I mentioned before, to deliver greater than 50% growth as we move through the year. A couple of comments about activity. Year to date, 2017. So in March, we had a second Canadian hospital announce the initiation of a Cysview program. That program is just in the process of being implemented, so we have not seen any results of Cysview purchase in these quarter results for that hospital. We expect there to be some activity in this quarter. We announced in April that we extended our in-license agreement for Cathogel to 2024. I mentioned earlier, since its launch in 2012, Cathogel brand has grown by double digits year over year. It's trending well to kind of on pace with our expectation, maybe slightly ahead of our expectation for this year. Also wanted to comment a little bit more about FeraMAX, the brand itself. So just this month, FeraMAX was named the #1 recommended iron supplement brand in Canada. That was for the second consecutive year. So Ensemble IQ Healthcare, which is the Rogers Media Group of healthcare professional directed publications, does an annual survey, in this case of over 2,500 Canadian healthcare practitioners, so physicians and pharmacists. And in this survey for the second consecutive year, both doctors and pharmacists surveyed named FeraMAX their #1 oral iron recommendation. And in both cases, so both professionals, the percentage of respondents grew versus the 2016 results, which already named FeraMAX #1. You can see essentially that kind of endorsement from the healthcare professional has made its way through to our expanded share in the latter part of 2016 and our secondary sales increase in the first quarter of 2017. I want to make a few comments about Cysview. So for those of you that have been paying close attention to our business and how we're developing, will know that Cysview features as an important part of our growth plan over this year, next year, and into the next several years. It won't be a disproportionate contributor, but it will be an important contributor to our growth. I just wanted to comment a little bit about how it's doing and where we see it going. We started promoting the product about 15 months ago. Today, there isn't a key opinion leader across the country that is not aware. Those in the large centers, the teaching centers, I think we've got pretty strong awareness of the product and in fact support the idea of using Cysview in managing non-muscle invasive bladder cancer. As I mentioned, there's a second hospital that has announced the initiation of a Cysview program. There was some recently published data, both last year and this, that indicates that Cysview reduces the progression of bladder cancer. We sponsored a pharmacoeconomic analysis in a Canadian context done by Canadian doctors on the disease state and the options available and cost to treat non-muscle invasive bladder cancer patients. This analysis shows that Cysview is cost effective. This is an important step in the process of laying a foundation to kind of build the brand and its acceptance in the marketplace. This analysis has been accepted for 2 presentations, one of which is at the Canadian Urological Association conference coming up in June. It's been accepted for publication by the Canadian Urological Association Journal, also in June. It really sets the stage for healthcare professionals to work within their hospital environments to get approval for use of Cysview. Just recently, this month, a couple of weeks ago, there was an announcement at the American Urological Association meeting in Boston on a Cysview inflexible cystoscopy phase 3 study. This was presented this month, and it showed improved detection of additional patients, almost 22% with bladder cancer in the surveillance setting. So just to differentiate, Cysview right now, in this case in the US, primarily what we're promoting here in Canada, is used for surgeons to better identify the cancer in the bladder and remove it in a surgical procedure. So Cysview obviously is not a therapeutic, it's not a diagnostic per se. This would expand the use more in a surveillance setting. In the US, our partner Photocure is going to file with the FDA for this expanded indication. In Canada right now, we're a little bit earlier in the commercialization process, so we're evaluating the impact of this data in Canada for our Canadian customers and examining whether we even need to file with Health Canada. We will file, and what we'll file and when we'll do it. Nothing to report there in terms of kind of a significant uptick, but really just a further validation that this is a product that solves a real problem, a real need in the market. We've got strong support amongst healthcare professionals. Having said that, we've had some challenges with this product. There's no question that to this point in time, the brand is not performing from a commercial perspective as we would have expected. I think we're, about 9 months behind in where we thought we'd be kind of age and stage. We've been doing all of the right things to set the stage, and what we're finding is that Cysview does not fit easily into the existing hospital business process and channels, and that's partly because Cysview is approved by Health Canada as a drug, but it doesn't have a therapeutic effect. It's not really a diagnostic. It's really a tool that the surgeon is using. So our key customer is actually the surgeon, the uro-oncology surgeons. they generally rarely use drugs. And as a result, they don't have a lot of familiarity with the process of getting a drug approved and implemented in the hospital. This isn't an insurmountable hurdle. It's something that we've been working on and faced with now since we started promoting this product. We now are feeling good about the interest and support of the adoption of Cysview in clinical programs. We now have got to work with our customers to kind of do the final implementation. We've got a number of sites that are in the process of doing evaluation. We expect to be announcing further sites adopting Cysview now as we move forward through the balance of the year and into next. So what do we see our growth drivers for this year and into the future? We still have some more growth to come in our existing portfolio. We see some new markets coming on from FeraMAX internationally. We have 2 cardiovascular prescription products that will be launching upon Health Canada approval. We have 1 women's health prescription product that will launch on Health Canada approval. We have a number of products and compounds that are in licensing, and you should expect to hear from us on those as this year progresses. So you're used to me talking about our balance sheet. This is a snapshot of the balance sheet. The quick highlights are our working capital is up from December 31st. Our cash and short-term investments reached just over $14 million, so up 2% from year-end 2016. And we continue to stand at no short-term or long-term debt. And not to say that we never see using it in our business, but we've been able to grow our business self-funding out of cash generation. Which brings me to the next slide, and just is a new one that we just wanted to talk about a little bit about cash and cash generation. So this slide shows you the last 3 years evolution, both of our cash position, going from $6.74 million on March 31st of 2015 to a little over $14 million March 31st of 2017. And that really speaks to the growth and evolution of our business, running a profitable company and being able to convert profit into cash. And you see our cash generation first quarter of 2015 was negative $1.25 million. Last year, in the 2016 Q1, it was negative $450,000. And this year, we generated over $300,000 of cash, and you wonder, why does that matter? What do you expect? Just an indication of the strength of our business, us sweating the details, and also doing that in the face of the first quarter of when usually we're doing our final tax adjustments or tax to be paid and bonus payments for the previous year. So the fact that we had a delta versus the year ago quarter of over $750,000 is quite significant. Our return on equity for the trailing 12 months, March 31, 17, was 28%. Net of cash, that number jumped significantly. It's a figure that we keep an eye on. Obviously, we're getting a number of questions about how we intend to deploy cash. I've spoken about this before. Bears mentioning again that we're going to pick our spots. We're going to make sure that we're careful and deliberate about how we grow our business and how we invest and what we invest in. We're not going to start jumping at things that don't make sense and don't meet our internal hurdle rates just because we have a strong cash position on the balance sheet. So our EPS for the trailing 12 months were 29 cents. This compares to the immediate prior 12 months of 26 cents, so a modest growth of 12%. Nothing to sneeze at, but we know that over time we should be able to do better than that. Just wanted to land on this page here just to remind you of our share count and how that on a relative basis hasn't moved a lot over time. There were some options exercised at the end of last year and this year, so you see that our current shares outstanding are just under 14.5 million, but we only have 171,000 options that are issued and outstanding. So total fully diluted of 14.64 million. I wanted to thank you once again for your interest in BioSyent. For those of you that are already shareholders, your support of the company. I can speak for everybody here, our team of about 45 people that we're sweating the details and working really hard on advancing the business. We recently introduced an employee share purchase plan to our employees where the company contributes to a certain ratio for open market purchases of BioSyent shares. And I can tell you that we've got 85% of employees at BioSyent have voluntarily elected to have monies deducted from their paycheck twice a month so that they can be in the market buying shares. So we take that as a great vote of confidence both in our existing business and how people feel here about where our company is going into the future. Thank you.